Good. Welcome, everybody, to the first of a number of sessions this week about discounted opportunities in investment trusts. In fact, we're starting with the theme of Europe, and whereas I think everyone on this call is an investment trust aficionado and therefore is interested in discounts on investment trusts, I think one of the really interesting things that will come out of today is that European equities themselves are at very interesting valuation levels. So what we thought we'd do is bring two managers with slightly different perspectives to talk about Europe. And the reason they have slightly different perspective is first we have Zered from Martin Currie, who runs a global equity fund, which is currently quite overweight Europe on a very active decision. And then second, we have Tom from Henderson European Focus, which is a very focused trust, which is essentially a stock picker over being a macro fund, but equally how those stocks are picked is very informed by some of the big themes that are developing in Europe and the world. So I think there's quite a meeting of minds between the two, but Zered obviously brings the different perspective that he's not compelled to be overweight Europe, but finds himself in that position at the moment. So what we'll do is start with Zered, and both our managers are going to speak for about 10 minutes. Please do put questions into the Q&A. I'll be filtering those whilst they're speaking, and then we'll have some time for a bit of a debate at the end. And so with that, I'll hand over to Zered.
Great, thank you. Good afternoon, everyone, and thank you very much for joining us. So we're going to highlight some of the aspects as to why we have been overweight European equities in the Martin Currie Global Portfolio Trust, and we're going to look at a few very interesting opportunities that we can harness through European stocks in particular. So starting with the next slide, let me just check that I've got control of the slides. I do. So the first slide that we're highlighting is some of the thematic opportunities that some of you will have heard us talk about before, 8 of them in total, which we have bundled into 3 buckets. The first one, energy transition, the second one, aging population, and the third one, artificial intelligence. If you look on the left-hand side on energy transition, we have 3 specific themes. First is green and alternative energy sources, as countries are focusing on reducing their carbon footprints and driving net zero in their economies. And as Europe in particular is looking at alternative energy sources, that creates some opportunities. Secondly, energy efficient infrastructure. We know that over 20% of carbon emissions globally come from buildings, so making these buildings more energy efficient is an important theme for us. Thirdly, electric transportation, both high-speed railways and electric vehicles. And again, we know that there's a lot of incentives and government programs to increase infrastructure spending in that area. On the aging population side, it's about healthcare infrastructure. Both post a global pandemic, the need to upgrade the healthcare infrastructure, but also as the population is aging globally in some of the key economies, there's a need to further invest in healthcare infrastructure. On the right-hand side, there are 4 specific themes that are related or linked to artificial AI. Firstly, technological and geopolitical fragmentation. So this is around the onshoring, nearshoring, friendly neighbor shoring, notably related to the semiconductor industry. It's creating this technological fragmentation whereby there's going to be some potential losers, but also some potential winners in equity markets. And then geopolitical fragmentation, which is related to the geopolitical angle of Taiwan and China versus US, China versus rest of the world. Secondly, cloud computing. As more companies have migrated online, the need to invest in cloud computing is important. The artificial intelligence is also creating a renewed CapEx cycle in cloud. And related to cloud, of course, cybersecurity, the need for corporates to invest more in cybersecurity. Thirdly, robotics and automation, and then the extension of that, artificial intelligence. So this is about companies moving the production lines nearer to shore or onshore, therefore the need to increase robotics and automation, but also that race towards harnessing AI to either stay competitive or becoming more competitive in a never more disruptive world. And finally, metaverse and quantum computing, two themes that are early stage, nascent, but where big tech are spending quite a lot of money. And that, again, is related to harnessing AI to the full. So we're going to talk about each of those, but those are important thematic opportunities for us, some that do provide us as long-term investors with very attractive opportunities. So if we look on the next slide, we're zooming in on artificial intelligence. And here the debate is about how sizable is the market opportunity. So this is something that will remain a bull-bear debate in the markets. From our point of view, we're only at the start of the opportunity. We're only seeing the tip of the iceberg, if you want to mention it that way. But on the left-hand side, what we've highlighted is NVIDIA's long-term addressable market opportunity as they see it, or as they saw it back in March 21, which was $300 billion. And then 12 months later, they upgraded that to $1 trillion. And we believe that that number could be upgraded further in their next update next year. But that really highlights the unknown around addressable market and therefore how sizable that market opportunity is for companies like NVIDIA. But the other unknown is the take-up speed. And we believe that the take-up speed is going to be very significant over the next 2 to 3 years. And that will create an important tailwind for companies like NVIDIA. The portfolio is about 31% exposed to companies with high exposure to AI, NVIDIA being a big position size at 9%, but we also have Microsoft as a company that can monetize from AI, and that's almost 8% position. ASML is clearly the company that is the enabler of the semiconductor industry, which is critical to this trend, and we have a 5% position in that. And then Adobe, as one of the software companies that is also able to monetize, which is at almost 5%. And to finish, Atlas Copco, which some of you might find surprising, but a sizable portion of Atlas Copco is actually related to providing vacuum technology to the semiconductor industry, to the clean rooms. So an important theme for us, and one that we believe will continue to surprise on the upside. When we move to energy transition, on the left-hand side, what's important is to highlight the significant challenges of energy transition, both for corporates, governments, and households. You can see how much upgrade there's a need to happen in order to reach the target of only 1.5 degree warming by 2050. The share of renewable energy needs to move from a quarter at the moment to over 90% by 2050. If you then look at additional capacity in terms of solar, that's got to more than treble over that period, wind energy more than double. And if you look on the bottom at the investment needed in renewable energy, the spend annually currently is about $300 billion. That needs to go to $1 trillion per annum. So more than trebling. Energy efficient infrastructure, again, $300 billion gets spent annually. That needs to go to $1.5 trillion per year. And electric vehicle infrastructure needs to go from $2 billion spent to $131 billion spent per annum. So you can see the exciting opportunity here for investors, because a sizable increase in spend across some of those aspects that are core to our three themes within energy transition are very significant. And on the right-hand side, how we're gaining that exposure. The portfolio is about 16% exposed to that energy transition through companies like Atlas Copco, again, because it's providing building equipment, infrastructure equipment to that segment. Secondly, Kingspan as a leader in panel insulation for buildings, and that's an important theme as we highlighted. Hexagon and another industrial equipment company sits in the technology space, but for us it's an industrial tech company And finally, SML, again, as an enabler of some of this infrastructure through that superior and privileged position it has in the semiconductor space. Let's move to healthcare infrastructure. So here on the left-hand side, we're highlighting that as the population is aging, and we're really looking at 16% of the world population being over the age of 65 by 2050, you can see that sadly various diseases are increasing with age. And one of our themes is 21st century diseases. These are notably oncology, so cancers, obesity, and diabetes. All three of them are actually interrelated. But you can see some of that cancer incidences will increase by 31% over that period. Heart failures will increase by 92% over that period. And diabetes incidences will increase by 49%. So the need for healthcare infrastructure is critical in an aging population. We favor medical technology companies. As you can see on the right-hand side, 12% of the portfolio is exposed to medical technology. Companies like Illumina in the genomic space, companies like Mettler Toledo, Coloplast, Wuxi Biologics in the drug outsourcing, drug development and production outsourcing space, and companies like ResMed in the sleep apnea space. So this is companies that, depending on which one you talk about, either capture the bespoke healthcare aspects of healthcare infrastructure or the remote patient monitoring in companies like ResMed, or in other words, the healthcare at home. So some interesting opportunities again for long-term investors. We then move to China. So China is an important area of debate at the moment about the potential health of the economy, and we can touch on that later on. For us, the important aspect of China is twofold. One, it's the second largest economy globally, so it's important to gain exposure to some of the long-term trends. And an important long-term trend for us is the Chinese middle-class consumer. And secondly, there's an aspect of China infrastructure within the country as well. So there's important aspects of industrial exposure and technology exposure. But then the third aspect to mention is the geopolitical angle. And because of that third aspect of geopolitical angle being a potential risk, we have been looking increasingly at gaining exposure to China indirectly through companies that have operations in China but not quoted in China. So when you look on the left-hand side, there's a lot of companies in Europe that give us that exposure, whether it's company in the luxury goods space like Kering or Moncler, or companies in the cosmetic space like L'Oreal, spirits like Pernod Ricard, or in the luxury car segment like Ferrari. And that all gives us that exposure to that Chinese middle-class consumer trend. And on the industrial and technology side, we've got Atlas Copco as one of the leader in industrial equipment, ASML as the leader in the semiconductor equipment space, and Hexagon that we've talked about earlier as an industrial tech company. The aspect to mention about Europe is that Europe gives you exposure to the global economic cycle. And what you can see here is Global Portfolio Trust as a diverse exposure when you look at the underlying exposure of revenue and profits of the companies that we're exposed to. So about a third of the exposure is to Europe by revenue and profits, about a third is to North America, and then the rest is spread across the various rest of the world geographies, notably China, Asia Pacific, and Japan. And the importance here is to look at exposure through underlying geographic exposures of revenue and profits and even production basis in order to ensure that we've got diversification. And as a reminder, we are a very concentrated trust with only 30 positions at the moment. So it's important to have a good sense of how we're exposed geographically or indeed thematically to ensure diversification. And so then on the thematic side, what we're highlighting here is our way of assessing global portfolio trust exposure. And very quickly, what we'll highlight is the three mega trends that we've identified, which are the three circles: in blue, demographic changes; in green, future of technology; and in black, resource scarcity. These are mega trends that will be there to stay over the next decade, 2 decades, 3 decades. There are themes on the left and on the right that we've also color-coded. Those might evolve over time. But what we do when we analyze companies is assess which themes are they facing and to what extent. That permits us at the point of building the portfolio is to assess how the portfolio is exposed to the various themes. This is an aggregated picture. The bigger the bubble, the more the trust is exposed to the theme to which that bubble is attached. So you can see that the trust is fairly well diversified across the 3 mega trends. And that's important in that 30 stock portfolio. We can also be clearer about which themes run through the portfolio and to what extent. And thirdly, we can see whether there's a theme we haven't researched or a theme that we want to gain more exposure to, therefore that we can then point our research work towards. But importantly, we would only gain exposure to a theme if valuations make sense, and that's very important. But ultimately, what this permits us is to put the global portfolio trust onto structural growth opportunities, looking ahead into the future rather than looking into the rearview mirror. And that is important for long-term investors. So we'll finish by concluding that our approach is concentrated, 25 to 30 stock portfolios, 30 at the moment, focused on the long term and harnessing quality growth companies. We give exposure to long-term structural growth opportunities through that thematic lens that we showed. We have a fundamental approach to researching stocks that we do systematically. We also have a proprietary ESG approach focusing on sustainability as part of finding these quality growth companies. And that enhanced data analytics that we generate from that fundamental research permits us to have superior risk analytics and therefore more innovative approach to portfolio construction. And with that, I'll leave it there.
Thanks, Ed. I'm pretty sure we'll be coming back to healthcare and luxury goods in a little while. Looking at the Q&A already, I think I predicted that one anyway. So I think, Tom, if we just hand over to you, and then, as I said at the beginning, I can see there's some questions coming in already. Please keep posting questions in the Q&A, and we'll have a good chance to go through some of those after Tom.
Okay, lovely. Thanks, Alan. Yeah, good afternoon, everyone. I'm Tom O'Hara. I'm portfolio manager of Henderson European Focus Trust. We hold 35 to 45, mostly big, large cap stocks in Europe. And as Zed said quite rightly, this isn't a play on European GDP or European politics. You get to access global themes, global economic cycles through large cap Europe. So we're very much focused on what we call global champions that happen to be born or listed in Europe, or companies that have the potential to be global champions. Now, I'd say one of the key differences compared to Zed's fund would be we're not an outright quality growth vehicle. We're much more of a core proposition. So I suspect if you were to put the two funds side by side, ours would look a little bit cheaper on aggregate. We're what we call valuation conscious stock pickers. So we care about the price we pay for stocks, and we have a pretty balanced portfolio on that basis. So that's been a strategy that's been in place for many years now, and it's tended to deliver quite well through us against all market backdrops, through all market regimes. And over the last 3 years, we're about 5% ahead of the benchmark here in Europe, and comfortably ahead of most of the peer group. So I'm going to go through some of the key themes that are informing our portfolio positioning right now. And again, Alan said at the beginning, there's a meeting of minds, and I think that's absolutely right in terms of some of the key thematics that we've detected as attractive places to invest in Europe right now. So with that, I'll start with one of two what we believe to be very profound changes that will ensure that the next decade of investment looks very different to the last one. And the first one is the change in the price of money. And I don't think this one can be understated. This chart shows that the total value of negative yielding bonds peaked in 2021 at, call it. So there's no more free money, there's no more negative yielding bonds. What that means in terms of the real economy is there's no more easy money to start up companies, business models that require long runways of being unprofitable, of being cash flow negative. That's a much more challenging business model to operate in a world in which there's no more easy money. And one of the terms that we like to use, and it sounds a little bit cheesy, so apologies, but we call it big is beautiful. And it's the idea that companies with strong barriers to entry, good profits, good cash flow generation, and strong balance sheets are likely to be more powerful in the era ahead than they were in the previous era. The threat of disruption from easily funded, unprofitable startups has receded. And now a very nice, tangible example of big is beautiful in action right now is the brewing industry. And I like to talk about beer almost as much as I like to drink it. What we're seeing in the beer industry is all of those craft breweries that proliferated over the last 10 to 15 years, courtesy of venture capital money, cheap debt, and so on. They're going bankrupt at a record rate right now in many markets. And so what we're seeing is that the big profitable brewers, we own AB InBev, the world's biggest brewing company, they're getting more powerful again. They're taking more market share. They've got the profit margins to withstand inflation and to reinvest carefully over the coming years. And they've got strong balance sheets. So beer is a really good example of the real economy implications of free money being withdrawn from various sectors. Now, it's important to say you've still got to be careful out there. Avoidance is a key discipline in successful investment. And actually, although we've talked a lot and everybody is now well aware of the fact that interest rates are higher, the real economy implications take longer to fully bear out. And there are still some parts of the market, in our view, that are yet to face that reckoning. And this is the NASDAQ, it's the darling of the last 10 to 15 years. 50% of the NASDAQ, by names, not by market cap, by names, will still be unprofitable in the next year. That's concerning. And again, you've got to be careful where you choose to invest in this market, because there are still some areas that have not fully reflected this profound change in the price of money. If we move on now, I can quickly touch upon something that I think Zed and I would both agree upon, which is Europe is cheap and it's at a record discount relative to the US. Now, one of the arguments that we always get is, well, you're Europe and the US economy is doing better. But as I mentioned, this is large cap Europe. It's global champions, many of which have very strong or even leading positions in their respective niches in the US, and therefore get to benefit from that US economic strength. What we find is that European companies across many sectors, whether it's energy, construction materials, even software, they come at discounts to their US peers. And so right now, Europe is fertile territory for stock pickers. Now, if I just move on to the second profound shift that we believe is imperative to access in equity markets in the next 10, 15, 20 years. And it touches upon many of the themes that Zed has already mentioned. We would condense that down into what we call the CapEx super cycle. And this is being driven by fractured geopolitics, increasingly fractious geopolitics, deglobalization, onshoring, and rapid technological progress. So read cloud computing and artificial intelligence there. And it's coming from both governments and corporates. So if we start with governments, the US is running an unprecedented 7% fiscal budget deficit. That's unprecedented for peacetime. Now, it may be optimistic to describe the current environment as peacetime, but traditional or conventional peacetime, this is unprecedented. And so the US is spending over $1 trillion in highways, bridges, roads, rail infrastructure, and incentives for corporates to bring their supply chains onshore or to friendly countries. And this is semiconductors, it's electric vehicles, it's energy security. We also see it from the rest of the rich world as well. The OECD on average is running about a 5% fiscal budget deficit. So there's a profoundly strong fiscal impulse in the world right now, which we did not see over the last 10 to 15 years. And to add to that, we're seeing that corporates are spending too. We've got, as an example, if we take the 5 big tech companies in the US, so that's Apple, Amazon, Google, Meta, and Microsoft. In 2019, they collectively spent $70 billion in CapEx. Now in 2024, they're going to spend $190 billion in CapEx, and they're going to maintain those CapEx levels probably each year for the rest of the decade. And so what we're looking at here is just 5 companies cumulatively eclipsing this unprecedented US fiscal stimulus. So we've got a huge amount of capital deployment coming from strong corporates. So whether we're worried about a soft landing recession, a hard landing recession, consumer weakness and so on, there are areas that are likely to remain resilient in the near term and in the years ahead. And corporate balance sheet deployment will be a key point to keep an eye on there. Now, if we just dig a little deeper and just look at Microsoft, which of course we don't own in Henderson European Focus Trust, but we can access its activity via the companies we do own. Microsoft will spend about $40 billion a year, each year for the rest of the decade, in order to fully build out its cloud computing and artificial intelligence proposition. And that means it needs to build about another 120 data centers. And so if we think of what data centers require from the point that the shovel goes in the ground, they require very significant foundation work. So water, energy, telecommunications infrastructure. Our construction materials businesses here in Europe, whether it's Holcim, whether it's CRH, get the benefit of that. Also, if we look at what goes into a data center or what a data center requires, they're incredibly energy consumptive. So one average data center has the same power requirement as about 80,000 households. And so if we just think about Microsoft's 120 data centers, it's like adding a city of over 10 million people to the power grid. And so the energy management hardware and software that goes into these facilities that kick out loads of heat, we've got Schneider Electric and we've got Siemens here in Europe. They are global leaders in data center equipment, both on the hardware and software side of things. Now, if we just think about the magic that goes into the data center, and it's the darling of 2023, NVIDIA. Microsoft is probably NVIDIA's single biggest customer, about 25% of revenues. We don't own NVIDIA in Europe. But if we look along the supply chain, NVIDIA outsources production to Taiwan Semiconductor. Taiwan Semiconductor builds the semiconductor factories or fabs, and into those fabs, it has to put all of the latest chip-making machinery. And that comes from European companies, listed, headquartered in the Netherlands, but operating with global leadership positions. And that's ASML, it's ASM International, it's BE Semiconductor, all held in size in Henderson European Focus Trust. And then just finally, again, Zed mentioned it a couple of times, we also own Atlas Copco. They provide a very unique vacuum technology to the semiconductor manufacturing environment. So ultimately what we're describing here is accessing the picks and shovels of a CapEx supercycle through European listed companies. So again, this is not a play on European GDP. It's not a play on dysfunctional Spanish, Italian, UK politics. It's all about accessing those global themes. So I'm going to start to wrap up now with a little bit on positioning. I've talked about the enablers of the CapEx super cycle. You can see that borne out in our overweight positions in industrials, in materials, in energy, and in information technology, because that's where the semiconductor CapEx names live. Now, in terms of avoidance, I've already mentioned the importance of avoidance. What do we avoid in Europe right now? Again, to simplify, we want to avoid the donors and we want to avoid the cheap debt junkies. Now, in terms of the donors, banks, repeated one-off profits taxes, governments are going to be hungry in the next decade because they've got to finance these fiscal budget deficits. Banks are an easy target. They have been for 10 plus years. They're likely to continue to be easy targets. Voters don't really care if governments tax banks. Utilities. We own no utilities. Again, business models that need cheap debt to build wind farms and the like, and also at risk of having the goalposts moved by hungry governments. Likewise, telcos, again, cheap debt addicts and potentially on the hook when governments come with their hands out. So that's a little bit about positioning. I'd like to finish with what we call the fallacy of disruption. Now, we're making a case for incumbents, powerful incumbents, strong global market shares, profit margins, strong balance sheets. And one of the arguments that we've always had, or one of the questions is, shouldn't you be owning the disruptors? You don't want to be invested in the disrupted companies. Now, that was very much the zeitgeist over the last 10 to 15 years. And despite that, we've actually seen very little disruption in terms of where profits reside in the real economy. And so I'd just like to leave you with some statistics from, this is the Fortune 500. So it's that representation of the US real economy. Now, there are 52 companies in the Fortune 500 that were born since 1990. So 1990 being the start of the internet age. There are only 7 companies in that Fortune 500 that were born since 2007. So when the iPhone was invented, the average age of a Fortune 500 company is 90 years old. And that's actually increased from 75 years old in the 1970s. So for all of the talk over the last decade during that free money era of disruption, growth, technology, all of that stuff that you needed to own and you needed to ignore the rest, we didn't actually see very much disruption at all. And so if the incumbents across sectors and economies the world over actually not only survived but thrived in the last decade, they're likely to do so even more so in the next decade when the oxygen of easy money has been removed from startups and from disruptors. So I'll end there and we can move on to Q&A.
Thanks, Tom. Thanks both. And we will have a chance to talk about LVMH and Novo Nordisk perhaps in a few minutes. But I wanted to start by asking about there's this very neat narrative, isn't there, about friendshoring and the globalization, and it strikes me that that's actually it's quite a complicated thing, really, isn't it? And so I suppose the elevator pitch for example, Europe is that it has a semiconductor industry, and everything both of you have said about the demand for that tells you that that's a positive for Europe. But semiconductors is a complicated business, isn't it? So what do you really see deglobalization in an industry like that looking like in a few years' time? Because it's all quite interconnected, isn't it?
Maybe I can start because we've done some important moves in the past 2 years, 3 years actually, to capture some of that deglobalization in the semiconductor industry. So as Tom mentioned, we think there's an important driver in the semiconductor industry. We're actually facing a super cycle over the next 2 decades easily. Yes, the industry will remain cyclical. So within that super cycle, there's going to be cycles, but we're really positioning for that super cycle. And we've got big exposure, whether it's through ASML, NVIDIA in particular, but also Atlas Copco indirectly exposed. What we have done over the last 2 to 3 years is actually switching out of TSMC into ASML, and some of it has been to switch away from a company that might be somewhat more challenged by the deglobalization and the fragmentation in the technological industry into a company like ASML, which will benefit from that fragmentation. So the nature of your question. And I'll put it very simplistically, where ASML was shipping its tools to Taiwan, the various main countries are aiming to reduce their dependence on the Taiwanese sites, and Taiwan produces over 90% of the leading edge microchips globally. So the US has invited TSMC to build some plants in its territory to reduce the geopolitical dependency on Taiwan. Japan has done the same, and Europe has also done the same, and will, in our view, increasingly continue to do so. So where ASML was shipping one tool to Taiwan, by the time these sites are live over the next 2 to 4 years, ASML will also be shipping some tools to the US, to Japan, and to Europe. That creates these economies of scale for companies like TSMC operating multiple sites. But for ASML, it's beneficial to their top line. They're shipping more tools to more sites. It benefits in terms of scale, and therefore is beneficial to their profitability. So that's a kind of opportunity that we have. At the same time, the other thing that this technological fragmentation does is where there was convergence in technologies, like with mobile telephony around 5G and then possibly 6G, with the issue that has happened around Huawei and the banning of using Huawei, we believe there's going to be technological fragmentation in the mobile telephony space as well, with diverging standards. And therefore, it will create, again, more complexity for mobile phone makers in particular, mobile telephony generally. And again, that complexity will create these economies of scale for some companies, but benefits to other companies, of which, again, we find ASML is an important winner of that.
I wouldn't add too much to that. I thought it was a very thorough answer. But I would absolutely agree that ideally you want to avoid those ones that have to heavily redeploy capex to other parts of the world in order to deal with this decoupling away from China. For the likes of ASML, yes, they've had some sanctions placed on them. We had some announcements in the last couple of months. Potentially causes a bit of short-term hassle around the fringes, but ultimately they will ship to TSMC's new fabs, whether they're in the US or in Europe. I would say the other thing that may happen over time regarding some of these sanctions of technology or certain technologies is the horse may have already bolted. You know, we've seen that the Chinese have achieved certain things through the new Huawei phone that maybe we didn't think they were capable of doing with existing ASML technology. And then the other thing I would say is the department that is responsible for monitoring and enforcing these sanctions, which is the Bureau of Industry and Security in the US, only has about, I think it's 600 employees and a $200 million budget. So it's basically got no chance in hell of actually being able to enforce many of these sanctions. So it's just something to be aware of in terms of the short-term noise that can surround this industry. But ultimately, the whole game, aside from the massive structural growth opportunity from cloud computing and artificial intelligence, the whole geopolitical game is to reduce dependence on Taiwan And then when that day comes, you'll probably find the US and the West no longer commit to defending Taiwan because they'll have enough semiconductor capacity in the West.
And I think, well, there's a question about ASML, and I think what both of you are saying in slightly different ways is ASML it makes machines that help other people make chips, doesn't it? And so what you're both saying is it's somewhat agnostic where chips are made, but the point is that the industry is moving the site of manufacture to other friendlier. So if the US invests in chip manufacturing, ASML still benefits. Is a kind of the simple answer to this question that's popped up in the box. So shall we talk a bit about, Tom? You mentioned unruly politicians, and maybe we don't need to consume too much time talking about that because you could point the finger at almost any part of the world. But Europe's valuation discount is somewhat a point in time, isn't it? But it's somewhat at a discount to the US historically. And do you think that the composition of the European equity market is changing? Coming back to this point about there being more technology in the index and more growth companies. Do you think the composition of the index is changing, and so you can see a day when there's no corporate reason, if you like, for European equities to be on a discount, parking people's perception of politics?
Yes, I think that's right. So if we put the politics aside, arguably the US benchmark being more tech heavy, being more, let's say some in my opinion, unjustifiably high multiple, low moat technology sort of hype companies, they're at risk of a greater de-rating because of there being no more free money around, and so that would derate the overall index to a greater extent in the US than Europe. I think what's quite interesting at this point is, you can argue about the different composition of the index and so on, but we find it between direct peers, and that's really the opportunity for us as stock pickers in Europe. So if I take the oil majors, they're at the moment 30 to 40% cheaper than the US oil majors, and that's an interesting one because it's quite a homogeneous sector. The companies don't differ greatly in their financial or business attributes. They're heavily driven by the price of a global commodity. So the fact that they're so much cheaper, I think, is an opportunity. And it's a challenge to the management teams of these oil companies who have responded by increasingly focusing their investor relations efforts on the US institutional base. So all of the capital markets days from Shell, BP, Total now are being held in New York. Most of the CEOs' roadshow time is dedicated to the US. And actually I had the CFO of Total in our office probably about 3 or 4 weeks ago, and he was quite pleased with the progress they'd made there. He said, over half of the institutional shareholder base is now in the US. So that's one way in which it informs corporate strategy, if you like. How do we narrow this discount? The other one is that you can try and move your listing to the US, and one of the companies held in our strategy is CRH, and they collapsed the Dublin listing, kept the London line, but moved their primary listing to New York because they were at a 50% discount to peers like Vulcan Materials and Martin Marietta, which is even more odd for a company like CRH, because actually if you look at its US business, it's the biggest construction materials business in the US. It just happens to have a Dublin HQ and a London secondary listing now. So again, that informed corporate strategy. So as long as we can detect it on a peer-to-peer basis rather than squabble about the index composition and so on, then it's a really interesting opportunity. It's an arbitrage that we as stock pickers in Europe can access.
I would just complement Tom's reply by saying that, yes, indeed, when you're looking at the headline valuation discount of Europe to the US, it's on historically low levels, as Tom mentioned in one of his slides. When you look on a sector-adjusted basis, that discount remains pronounced. So yes, some of the discount is related to a higher weight of technology in the US indices. Even adjusted on a sector-neutral basis, you're looking at somewhere around 10 to 20% discount of European equities to US equities, which again explains why we're running a big underweight to US equities and an overweight to European equities, because that's where we see more valuation support.
Mm-hmm. Let's turn to consumer discretionary, or if you like, luxury goods, which has obviously been a big kind of positive news story for European equities, without VMH becoming such a large company. And both of you own consumer discretionary or luxury goods companies, and a consistent pushback from investors, and I can see a little bit of that in the box, in the Q&A box, is cost of living. How long can Chinese consumers keep buying handbags, sports cars, watches, etc.? And it strikes me that that kind of skepticism is pretty consistent, and maybe that's why they're not as overvalued as people think. But I'd be interested in both your views as to how you see those companies' earnings. How well will they hold up if interest rates are higher for longer and the consumer continues to struggle?
I'll maybe give Tom, if I can, just a quick few pointers around the consumer trends. So at the moment, the market's very focused on the near-term Chinese economic momentum, and indeed the leading indicators for China have been weaker than expected, both on the manufacturing and the services side. On the services side, they're still above 50, so the economy is still expanding, and the services side of China is about 55% of GDP, which is about twice the weight of manufacturing. So whilst we might think that China is a manufacturing-led economy, the services is actually twice as important. That's the first point. The second point is it is near-term, and some of its share prices have reacted quite significantly to those near-term headwinds around Chinese consumption. We believe that the longer-term opportunity remains strong in terms of Chinese middle class. If you look in an economy where population is now peaking and is actually going to be declining, the Chinese middle class cohort should be expanding at about 6% per annum. The consumption should be increasing at higher rate than that annualized, and their luxury goods consumption, in our view, even higher. So you're looking at still very supportive trends, and it gives an opportunity for long-term investors to be involved in some of these businesses that are really well positioned, that have very strong brand equity, therefore strong pricing power, and that feeds into very high returns on invested capital, which is a type of businesses we really like. Profitable, high returns, compounding over time. And yes, every so often there'll be some cyclical scares, as they are at the moment, but that's when you want to be involved. I remember in my career, the time to be involved in luxury goods was March, April 2009, which was when the world was collapsing. The global financial crisis was leading economists to believe that we were heading into a really severe recession, which we were. But that's when companies in the luxury goods space get sold off. And that's where, for long-term investors, it creates a great opportunity to be involved. So when we're looking at the market at the moment, we believe that around now, and it might be that it's another 1, 2, possibly 3 quarters of weak trends for the luxury goods space, and therefore ongoing weakness in share prices, but it is providing a very attractive valuation opportunity in that sector.
Yeah, so on our side of things, we're quite boring in that we own LVMH. It's best in class from a business model, operating performance, margin perspective. That said, I do have some near term, and it is more tactical, some concerns about B2C in general, particularly those areas of the market or of the sector which you could say had a fantastic COVID. And luxuries in that basket, spirits is another great example. And obviously we had Diageo disappoint the market on Friday. These companies had a fantastic COVID. People were locked up. They had elevated savings rates. They wanted the dopamine hit of a sort of feel-good purchase. And so the thing that I'm unsure of right now is the extent to which we have to go through a prolonged destock and a reset to growth expectations as the consumer just starts to hesitate a little bit more. And, if we take Diageo on Friday, tequila's been driving probably 40% of its top line growth over the last 5, 6, 7 years. And during COVID, people were very happy to pay $100 for a premium bottle of tequila. They'll probably hesitate a little bit more over that purchasing decision right now. So we're sort of avoiding or minimizing exposure to some of those B2C areas that had a very, very good COVID and all of the right conditions in terms of getting that customer conversion in terms of the purchase decision. But I absolutely don't disagree with Zed that the emerging market penetration opportunity for the best luxury names is still vast. And whether it's going to be China that still will grow its middle class, or India, Indonesia, Vietnam, you name it, there's still a hell of a lot of runway for the quality luxury brands.
Great, thanks both. And just mindful that we're creeping up on the hour, perhaps we can finish on kind of trust specific question. And Tom, if we perhaps go to you first. How have you been gearing the trust in the last couple of years, and what, if anything, should we read into your current level of gearing?
Yeah, no, it's a great question because we actually very fortuitously placed, call it 30 million sterling of very low cost loan notes in early 2022. So we've got 25 and 30 year tranches, and the average interest rate is 1.57%. So it pays for itself, more than pays for itself, even if it's just sat in the bank account. Although HSBC are a bit stingy, I think they pay us about 2.7% on that cash. So we have put a chunk of it into what we regard as cash equivalents, so short dated government instruments, because you can get 5% on that. Now, in terms of gearing, we're basically not geared at the minute, and even about a month ago had some net cash on top of that. So the reason for that was we made some sales. So we sold Hugo Boss on the discretionary theme. We'd sold the very last of our banks exposure. And just given the speed of that yield curve on inversion, so 10-year rates catching up, 20-year rates catching up, it didn't feel like necessarily a fantastic time from a tactical perspective to immediately redeploy that in the market. Now, in order to provide further illustration of how we can utilize that low-cost gearing, in September 2022, so at the lows of the European market, or let's call it the European market trough, we fully deployed that gearing. So on a normalised basis, the gearing's worth probably 7.5–8% of NAV. But obviously, when the NAV shrinks because the market has a drawdown, it can increase as a percentage of NAV, and we exceeded 10%. And since then, we've rolled it back. And right now, you know, the trust is just on the margin, that bit more defensively positioned. You know, I don't think there are any absolute screaming opportunities right now. And bear in mind, we're going through results season, and given hedge funds dominate daily trading during results season, that tends to bring about some opportunities. So we're kind of poised, ready to redeploy when the market conditions feel more favourable, when some of the stock specifics feel like an absolute bargain. But right now, we're just keeping our powder dry, and we earn a very good return by keeping that low-cost debt in cash equivalents.
And Zed, how's gearing for you at the moment?
So for us, gearing is seen as a structural tool to be geared into the stocks that we're already invested in. So that's really the way gearing gets deployed. And the reason it's structural rather than cyclical, it's very difficult to time the market, and therefore being exposed to businesses that we believe in the long term will create value for shareholders through the cycle, because some of the businesses are indeed cyclical, but all of the businesses have more than covered the cost of capital through the worst of the financial crisis of 2008 or 2009. Therefore, we just deploy that on that structural aspect and harness those compounding characteristics of those businesses that we're invested in.
Mm-hmm. Okay. Well, thanks both. We're just coming up to the hour, and Tom in particular, I'm sure you're relieved to have an hour talking about European equities without being asked about Novo Nordisk, which I did say I might ask about, but let's save that for another time. And if anyone's interested, there is actually another Kepler video from last week with some quite lively debate about that. So you can always go and look at that. Anybody on the call who has a follow-up question, please do email us. We do sometimes get questions that come in afterwards, and we're very happy to try and answer those if we can. And this video and the slides to go with it will be on our website shortly, so you can download a copy to peruse at your leisure. And with that, I'll thank both of you for your time and your patient answering of questions today, and we'll see you on the next one.
Thank you very much.
Thank you very much.
Have a good day.
Cheers.